Hi, everybody. We are back again. We have our last panel today. Thank you so much for joining us for this last day of Longmont Startup Week. We have a really wonderful panel. We're going to be discussing how investors think, how to present yourself and talk about your business, and what not to put in your pitch deck. We have three very accomplished gentlemen joining us, Murdoc, Khaleghi, Judd MacRae, and Peter Adams. I'm going to ask them to introduce themselves and give a little bit of their background for you all.
All right. Well, I'm holding the microphone, so I'll start. So I'm Peter Adams, and I am the executive director at Rockies Venture Club and also managing partner at the Rockies Venture Fund. So what that means is I am simultaneously an angel investor and also a venture capital investor. So I'll be able to give you some perspectives on those things. And just a little background, Rockies Venture Club has been around since 1985. It's the oldest angel investing group in the United States, and we do about 30 deals a year. So pretty much any month we're doing 2 or 3 deals. We have a lot of process. We've got several hundred investors who we're syndicating on deals, all coming in together on deals. And then we also syndicate with other angels and VCs throughout the US. Other quick things, I'm on the board of the Angel Capital Association and Angel Investor Foundation. So that gives me great insight, not just into our 200 angels and VCs and how they think, but also how angels and VCs think around the United States and around the world. So when you do your questions, glad to help with anything you've got there.
Hi, I'm Judd MacRae. I'm the Vice President of Finance for a company called Stateless, which develops cloud connectivity software. We're a Series A company that was founded out of CU. Prior to that, I was with Richter Financial Studio advising other early stage software companies on capital formation strategy, growth, that sort of thing, and have spent kind of the last 10 years in the startup software space.
And I'm Murdoc Khaleghi. I'm an emergency physician, and years ago I started launching health technology ventures, trying to bring together a background in engineering, medicine, and business. I've been fortunate to be part of a lot of great companies that have since IPO'd or become unicorn, and so more recently done what anyone does who's done that a fair amount and joined the investor side, including on Rockies Venture Club for the last few years now. So I continue to launch health tech ventures, but I get to enjoy sitting on, sort of straddling both sides of the table, the investor side and the entrepreneur side.
So this is really our heavy hitter panel, as you can tell from the introductions there. So with that in mind, I think jumping into this first question of how do investors think? We have so many people who either have started a business that is capable of taking on equity investment, or people who maybe are aspiring to do so. What limited information the public gets about what investors think is just what's on, out there on Google that you can look up, or in the TV show Silicon Valley, for example, that kind of media depiction. But let's hear directly from all three of you just on what is that mindset? What are investors looking for? What is it that they want? And how can people who are looking for equity investment sort of use that mindset to their advantage? Yeah, Murdoc, go ahead.
I mentioned that I kind of straddle the investor and entrepreneur side, and something I've come to notice over the last decade is they tend to have very different desires and needs. The entrepreneur is trying to solve a problem, usually one they care about. And so they're not thinking about exiting this problem, they're just thinking about solving the problem. And they need investment to solve the problem. But the investor is thinking about the exit. They're thinking about when they're going to get their money back, what rate of return they're going to get, how they're going to get it back. And so there's just different priorities. And it's incumbent upon the entrepreneur trying to seek the investment to satisfy the investor needs and think from their perspective, and to start to think about that exit, even if it's not their own priority, it is the priority of the people that are going to supply them the capital to work on that problem that they care about. So to be able to successfully work on that problem, you have to try and have an empathy for what the investors want.
I'll give a sort of a flip side perspective. I've got a lot of things about how investors think, but for first-time founders who are approaching investors and they're not really experienced about it, a lot of times founders get really intimidated by meeting with investors. This is a very opaque world. There's a whole different language, a set of processes, and certainly you should do everything you can to educate yourself and learn all of those things, and that's really important. But on the other hand, and this is true especially for angels, less so for VCs, but when you're talking to angels, you may be imbuing upon them a lot more knowledge and experience and confidence than is justified. So it's best to sort of assume that your angel investor doesn't know anything about what you do and to start back at square one. A lot of companies sort of get so excited and they figure these investors know everything, and it is not true. So make sure you lay the groundwork for whatever it is you're trying to do, and angel investors love learning. And if you can teach them about your industry and the unique gaps you're addressing, that's really exciting to angels, and it allows you to bring them along in the process as opposed to making assumptions. And then just final thing about psychology is it looks like angels and VCs have infinite amounts of money, and it is not true. And in Colorado, I'll say, when somebody writes you a check for $25,000, which is sort of the average angel check, that's a lot of money to them, and they take it very seriously, and they're kind of afraid. So when you're thinking about that, instead of thinking, oh, these are these people who are all powerful, think, oh, they're a little bit afraid to write this, and so why don't I do what Murdoc suggested and give them the information that they want in order to make a good decision?
Yeah, Peter, I think that last comment is particularly accurate. And even if it's at a large venture fund, our last couple of rounds have been out of large funds, and you still need to empower that partner to stick their neck out there, give them the data they need on why this market is exciting, why that product and the technology that you're using is so exciting, why the timing is accurate, and a really clear path to how you're going to reach your next milestones, whether that's an exit at the next one, whether that's cash flow positive, or whether that's the next funding round. But point being, you're absolutely right. Everyone needs political capital and cover to write that check, even if it is a large venture fund.
Well, and that's a great point, Judd. When you are pitching to VCs, they are more sophisticated, but keep in mind how a fund works. The person you're talking to is probably not the sole decision maker. So next Monday, they're going to have to take your deal back to their investment committee, and they're going to have to pitch it to them. So you've got several other people who have to be convinced you may never get to meet. So to Judd's point, be sure you give them all the power and information that they need to speak on your behalf and push through the rest of the board.
Yeah, I agree with that. I mean, I think when we look at that process, we're trying to get a meeting with a partner first off. But if that doesn't work, you're setting a teaser to get through that gatekeeper, the investor, the associate, getting in with a partner, and to your point, empowering them with those facts. And oftentimes, more importantly, they're going to go out and do some homework, right? They're going to call people in the industry that they think are your customers, and you want to empower them on that journey with the right questions, the right target audience, and what they expect that outcome to be, so that, again, they're getting that positive feedback loop, which reinforces their confidence, so that when they go to the partnership and pitch the partnership, it's a really clean process.
And just to follow up on that, I'm curious, based on your experiences and what you've know and seen, what are some key differences people should know about the differences between front range investors and VCs and those in Silicon Valley?
So this is a personal perspective. It's not research-based or objective. I have a lot of companies that I work with that are Silicon Valley-based. I have a lot of companies that are located more in the middle of the country. I have found the middle of the country investors to be more discriminating in a positive way. And so what I mean is, I've had plenty of companies that I've worked with in the Bay Area. You can have an idea, and they'll write you a $5 million check on a $25 million valuation. But for sort of middle of the country companies, they're actually looking at how far along, how much revenue, what's the multiple of revenue. They're being more discriminating financially and trying to make the best investment possible, which I appreciate. Because I feel that requires more sophistication. I mean, when you have the ample deal flow that the Bay Area does, maybe you don't need that level of discrimination and sophistication. But here, where there's a lot of great opportunities, but not as many, you have to be more forensic, and so I applaud that of front-ranged investors.
Well, I'll add one other big difference, and it follows on what Murdoc was just saying, and that is one big difference is Silicon Valley VCs and investors are all going for the unicorn, or even unicorns anymore are not enough now. It's decacorns is what I'm reading about. It's got to be $10 billion valuation. So that changes the entire dynamic between investor and company and how that works. It changes the timing. It changes the pace of growth and the speed that the company needs to go at to raise that kind of funds. So it's go big or go home. Whereas in the Midwest, well, and we will take unicorns any day, just to be clear. So, we are not anti-unicorn, but it costs a lot less to start and grow a business in the Midwest, in Colorado especially. And so when you are raising $5 million in Silicon Valley, you could probably raise, $2.5 million here, $1.5 million here, and accomplish the same milestones. And it's all about accomplishing those milestones to get to the next raise or cash flow positive, whatever the next step is. So keeping in mind that it costs less to do business here, and but you'll have also smaller raises. So we'll try to break things up into tranches, meaning instead of if you need 5 million total, we might start with $1 million and then 3 million and so on. And that's sort of a Midwest thing as well, as doing smaller bites as opposed to just here's 10 million bucks, go and become a unicorn next year.
So another question, moving into our next topic about how founders present themselves and their business. What are the kinds of things, the qualities or certain things you look for in investable businesses, but from a founder DNA perspective, their personality or what have you?
Well, for me, there's probably the biggest one is clarity of strategy. And, when I'm watching a pitch, a lot of times I really don't get what the company is pitching. They've either started in the middle of whatever it is they're talking about and left me behind from the first slide, or maybe they just haven't worked out all the steps. And I've had founders come to me and say, well, Peter, can't I just figure out what I'm going to do in the first 2 years and then we'll figure it out from there? And the answer is no. You can't. You can certainly, figure out what your exit is going to be and how you're going to grow this company and to whom you are going to sell it and for what value proposition. And you can change your strategy as you go along, but you always have to have a complete strategy at any one point. And that clarity is what leads to investability, because without that clarity, you're going to make a lot of mistakes, you'll have a lot of surprises, and this is why we hear about unfortunate things happening to startups.
When Peter mentions clarity, he's absolutely right, because that has value on two levels. One, so we could just understand as what your business is. As he pointed out, often angels don't have a familiarity. Of course, they're not going to have nearly the familiarity as the founder does. And so you have to kind of treat them like they know nothing and bring it back to the basic level. So you can't create a founder can't create a presentation for themselves, but create a presentation for someone that knows nothing on the topic, which is harder than it sounds. But also with clarity, investors are always doing a meta due diligence. They're evaluating you, the founder, by the clarity and quality of your presentation. I've seen great presentations help a bit, but a bad presentation makes it a no-go. It will kill you. On Rockies Venture Club, I work with some others to filter the life science deals that come through. And so oftentimes it stops at the pitch deck. If the pitch deck is not clear, then we're done, even if it's a great potential business. So clarity is also important on that meta due diligence level, so we can evaluate you, the founder, and see how well the quality you can put to things.
And I would just add that I think that goes beyond just the founder and permeates through that early management team, right? I mean, that the team is a huge part of investing in an early stage business. How likely is it that the skill sets are there to grow the business? And more importantly, how likely is it that the people around the table are going to be able to attract and retain the right kind of talent to grow it? And so I think that goes well beyond the founder.
So this idea of clarity, I think, is one. I have also preached clarity to a lot of people in their business pitches and whatnot. I think that is a constant battle. It's a struggle for many people, especially when you're so close to your own business idea and everything. It can be very hard to articulate. But let's dig into that for a moment. I would love to hear a little bit about what constitutes, like, how do you create clarity in your pitch deck, in your pitch? When you look at a pitch and you say, oh, this is very clear, I completely understand your business model, and your strategy, what does that look like? And what kind of tips and tricks might there be to help people approach creating greater clarity when they're pitching themselves and the business?
Well, I'll address that maybe by just sort of dissecting what a good pitch looks like. And there's a lot more in the pitch. The pitch is really just the tip of the iceberg of your strategy. So let's just be clear, that's 2%. And then there's a whole lot of meat below that needs to be there. And that meat actually leads to that clarity. But as you dissect a really good pitch, it's going to start with the problem. And the way that the problem is stated is super important. And what I mean by that is this something that is going to be game-changing and changing an industry, or is it something that's going to be a 5 or 10% incremental improvement upon existing technology? So hopefully the former. So you've got a game-changing technology. That's great. It's going to, and you can sort of point out the gaps in the current incumbents, people who are currently playing. That's really important to point out. So you're not going to be another food cart or whatever else that's just like everybody else. It's going to be something really different. And then you can go into your technology. Then you can go into your customer and why this is of such extraordinary value to the customer. Then you can go into how you reach that customer, which, by the way, is super important and overlooked. The whole idea of the channel strategy and how you're going to approach those customers is probably, especially at the angel and early stage, it's probably one of the greatest risks for companies and investors, is to figure out that product market fit and also the lowest cost of acquiring customer to the lifetime value. Anyway, then throughout the pitch, then you can go on to your competition, you can go on to your finances, you can go on to your exit strategy, the team that is going to make it all happen, and then end up with your ask. And so just thinking about how that works, all of those things flow. They flow from one to the other. And there are some pitches I see where it looks like somebody did 52 pickup, and just tossed the whole thing up, and it's random. And so think of your pitch as a story that says, hey, there's this problem in the world, but we're here to solve it, and look at these people who get this great value, and we're going to make some money, and then we'll be acquired, and it will be taken even greater heights by this entity that would acquire us. So think about that in terms of clarity, and storytelling is a great way to pack more information into a smaller amount of time.
Yeah, I think there are just a couple areas to expand on that I, especially as a finance person, drill into. And one of those is the market. So there's a lot of conversation around the market size and whatnot. And I've seen too often where people just pull out very large numbers. They did a quick Google. Oh, the organics industry is X billion dollars, or in our industry, the networking space is a $2 trillion industry. And it's pretty clear that isn't relevant to the space we're really operating in. So what's my market for my solution? How does that market change over time? And then I think probably the most important piece is how are we timed in that marketplace? So we've talked about the problem, why this is so compelling. We've talked about the technology that's going to solve it, which is your solution. What are the market dynamics? What's forcing this change that's going to make the status quo no longer relevant? And why is right now the time for someone to put money into that so that you can move? So I think that's a really overlooked piece. One is just getting really clear on what your market is and how big that piece of it is, and then the timing of it. The other piece, Peter mentioned the pro formas. There's two main components to that. If you're in a software industry, oftentimes you're hiring engineering team or others that are not directly related to customer acquisition cost. I personally love to tie that back to how is that increasing our ability to accelerate, right? So if I'm going to hire 10 engineers, am I increasing my serviceable addressable market? In other words, am I adding features or product capabilities on there that are expanding my market sizing? Am I adding features or products or optimization that allow me to acquire customers more cheaply or faster? In other words, what's the use of that? And then to Peter's point, with that go-to-market motion, oftentimes at the angel, seed, even Series A level, you don't necessarily have that fully figured out, but you need to have, to Peter's point, a really compelling story of how you're going to approach that, and you need to have some assumptions around what the cost is to acquire that, right? So how many salespeople, what marketing, if it's channel, who are the channel partners I'm looking at, how much in rev share am I looking at doing, what are the headcount and lag to bring that to fruition, discount it a little bit, because you're not going to hit all of your targets there. And then if you look at how much capital you're asking for, can I reach that next stage, right? What's the next funding milestone for the business? What do I need to accomplish to get there? And is there a high probability based on the plan I just pitched that we're going to achieve those milestones?
Hey, just before Murdoc goes in, I just want to give a quick +1 to what Jed said, because there's this mythology out there that pro formas are useless and they all look like hockey sticks and have no meaning. And what he just walked you through is how to get a believable pro forma. And this is what groups like Richter Financial Services do, that really do a good job of understanding what are the drivers of revenue, what are our measurable costs, how do those tie together. So there is a ton of believable stuff that you can build in. And certainly I will tell you this, that investors look very closely at those numbers. And so don't take that lightly. Back to you, Murdoc, sorry.
Yeah, I mean, what creates that believable pro forma that Judd described really well is intelligent inputs creating specificity. It makes it informed. And in terms of specificity, as he also mentioned, if people are too general about the market size, Peter likes to make the joke of, well, if we want to go with the biggest market we can, well, this is part of the $10 trillion economy, and if you can just get 1%. So specificity is great. With life science deals, I often see people start off with the problem. As Peter pointed out, there's a formula for a presentation, and it always starts out with the problem. People are too general about the problem. How often I've seen the problem, healthcare is broken. Or they think they're getting more specific when they say, costs are rising this much % per year, or we have a system of sick care instead of, healthcare. Yes, those are all problems. I agree with you. And sometimes people think, well, if I start generally, that's how I start to engage the investor, and then I get into the more specific. It's actually the exact opposite. That early attention, the first 30 seconds, minute, is your most valuable. Please get to your point then, or you will start to lose the investor. So have your specific problem, the specific solution, the specific market. Now, it's interesting how people then figure out how to do this. Like, well, is my problem specific enough? Am I the right solution? People, they might hear someone like us say, well, get into the mind of the investor so you can create the right presentation for them. But how do you do that if you don't actually live there? It's not, you can't do it just by thinking about it. You just can't think, well, I think an investor wants this, so I'm going to do this. You create an initial deck following the formula Peter described, and it is a formula to be followed that we are constantly amazed at how many people do not follow that formula. But then, what you have to do is you have to know that it's conveying the right message to others, is show it to others. And you have to get feedback, and you have to do a dozen passes. And that's the other thing that we're often surprised that we don't see. You can tell a presentation hasn't gotten feedback that would obviously point out, well, this isn't clear, this is out of order. Getting that feedback is so important. I'm certain if someone could create like an artificial intelligence that could give you feedback on a presentation, people would absolutely get that. Great, I can make my presentation. But showing it to other people is so much harder. It's so much harder to reach out and accept that critical feedback. It's a harder thing to do as humans. But if you can build up that skill as a founder, that's going to help you in all aspects of what you do, because the path to success for any founder is one full of critical feedback. So that's the other thing I'd recommend doing.
I'm just going to jump on the soapbox a little bit to support Murdoc's point there, because one thing that founders do is you go to pitch events and you see companies pitch and you go, oh, that looks easy. And it turns out that the ones that look easy probably spent dozens and dozens of hours practicing. And I've had people who should know better, and they get up and they totally bomb on the pitch. And I'm like, what happened? And they're like, oh, well, I didn't practice. I'm like, well, this is your last chance. We'll see you in maybe a year or two. It's not like you can come back next month and pitch again, because nobody wants to see that, whatever you just did. So there's a Malcolm Gladwell book, I think it was Blink, where he talked about the early stages of the Beatles and how the Beatles worked in German dive bars for years, just playing these dive bars. And it was only after just doing it over and over and over again that they finally got good and got their breakout. And I see pitches where I can tell they've been to the pitch equivalent of German dive bars. And they're really great when they get out there and pitch. And you're like, yes, this is one who's practiced and is ready to go.
Yeah, just a couple metrics to put that into kind of a frame of reference. I think we had 20 different iterations on our deck before we actually went to market. And we had pitched, obviously, our internal investors, our board. We pitched a whole series of advisors that had gone through it and just kept hammering it. And then the other thing, to your point about feedback, Murdoc, our CEO, Murad, at the end of every pitch, will ask the investor what resonated, what didn't resonate, do you have any feedback? And it does, I think, two things. One, the investor has to reflect and think back on the pitch and, well, what did I like about that? What worked well? Oh, that's interesting. But we also, from several of them, gave us pretty honest, really good feedback. And we were able to go back and say, yeah, that wasn't clear. That didn't work well. And spend some time before the next one refining it.
You know why that's such a good technique is it creates this partnership type relationship between the pitcher and pitchee. And it's not like I'm selling you something and you better invest. It's more like, hey, we're in this together. If we're successful, we'll all be doing great and having a lot of fun. And so there's a trust and a confidence that it takes for him to do that. And so I'll just say that's a very mature and no doubt very successful way to go about doing a pitch.
So if the pitch and the pitch deck are the wallpaper or the paint, that decorator room, obviously it's only going to be as nice as the smoothness and the quality of the build of the walls underneath of it. So I want to talk a little bit about the fundamentals and how they come out in the pitch and the pitch deck. What kind of things, we have talked about this a little bit, but I want to specifically focus on what are the kinds of fundamentals that a business needs to show that really make you say these people have their stuff together, they know what they're talking about, this is a business that's headed in the right direction, and how can those be communicated the most productively?
So to me, there's really two types of companies with different fundamentals that I focus on. Once a company is post-revenue, I get a lot more interested in the financial numbers. And it's not, some people say, Peter often wisely says, there are people that'll mistakenly say, oh, it's harder to value, pre-revenue company, post-revenue, which he's absolutely correct in saying that's not necessarily true. But when they are post-revenue, you can't help but focus on the revenue, what's their gross margin, how fast are they growing, what's their biggest challenge? Is it supplying inventory because there's so much demand? Investors love that problem. Or is it, we're not getting enough demand and we need the money for more marketing or a VP of sales guy and then we'll get over that hump? we don't like that problem as much. So yeah, it comes more about financials post-revenue. Pre-revenue, it varies a lot more by the company. If they're trying to do a product or service, we have to then figure out if there's truly a demand there, because there's not those financial metrics yet. So what other metrics can we use to justify the demand? What other tools can we use to evaluate the company's likelihood to be able to create that sellable product and to sell that product? So it starts to get more diverse when you're pre-revenue, but certainly not that you can't value pre-revenue.
Well, the foundation, since you're using the building analogy here, but the basement is the exit strategy. And so this is really the thing upon which everything is built. And so you'll see a lot of people will ask VCs, what do you look for? And they'll all say team. And then they'll say, some people say team, great product in a big market. So that's a good answer, and those are all very important. But I think the exit strategy is the single unifying thing that is important. And that sounds a lot easier than it is. A lot of people struggle with understanding what an exit strategy is, and frankly, it's unfortunately named. If I was calling it something, I would probably call it the commencement strategy. You leave high school or college, you have an exit strategy, you're graduating, but they call it commencement. It's the beginning of something new. And so if you think about the exit strategy as a commencement, you think, well, what is going to start new and why is that going to happen? And it causes you as a founder to think very deeply about the industry and where that industry is going, and you partnering up with your acquirer or your IPO, if that's where you go. That is a time when your growth curve has been going like this, but with the resources and capital and connections and distribution channels, that is where whatever you're doing and whatever you're passionate about can be tenfold bigger very quickly. And so if you're passionate about something and you say, my business is my baby, so I don't want to exit, well, you're not a very good parent. Really, for your parent, because for your baby, because you're keeping that baby in the basement. You're not letting it go out and become everything it can be. So if your business is your baby, think about that commencement and what partners you could hook up with to take that thing to as big as it could possibly be. So just that little shift in language changes how you think about it. And another piece of really bad advice you'll hear from well-meaning investors and advisors and others is just build a good company and the acquirers will come along, I promise. And it's true, acquirers will come along, but they may not be the best acquirers, and you may not create the greatest value proposition, and the timing might not be optimal. All of those things are risks of taking a passive approach to an exit strategy. As an analogy, I think of it as like a middle school dance. You can go to the dance and you might have your best shirt on or whatever, you look good, and somebody might ask you to dance, but it may not be the person you really wanted to dance with. And to have the best dance outcome, you pick who you want to dance with, and then you ask them to dance. Well, it's the same thing for exits, and this is a long-term relationship creating process. It's not like suddenly in 5 years somebody's gonna knock on your door and say, hey, we're here to buy your company. Better to figure out, well, who are the optimal acquirers? Why would they want to acquire us? And then create a relationship that may last 2, 3, 4, 5 years. And now when the time does come for the company to be acquired, you've got multiple players who will bid against each other, create the greatest value, and the company for whom your company will add the most value will be the one who will likely end up buying you. And so that kind of intentionality is a way better way than the passive approach. And just a couple other things about exits, because there's 6 things, because people don't really understand what they are. So that's 2 of them. Other is timing. And you should always be ready to be acquired. And so, again, it's not magic. 5 years, boom, you're going to be acquired. I know one Techstars company got acquired 8 months after founding. 8 months. Wow. And that was not their plan. But they did all those other things. They met all of the incumbent players in the market. They figured out where they had gaps. They built a product that filled those gaps and kept those relationships going. And sure enough, Intuit called them up and bought them 8 months after they were founded. So 2 founders, no dilution. It was a really good outcome. So following that is important. One thing that those founders told me is one thing that led them to be successful was they had a great team of experts to help them through the exit. So most founders have never been through an exit, and this is a scary and mysterious thing, and so people tend to avoid it and put it off, which is really a bad strategy. Better to create early relationships with investment bankers, with transactional attorneys, with CPAs who can, have all your audits in place. These are people who've done this time and time again, who can know how it works, walk you through, and have you have no surprises. So all of those things go together to create a good exit strategy. The final thing is, and this is very non-businessy, but actually it's the core of business, and that's values alignment. And you're going to be acquired by somebody. This is a relationship which M&A, mergers and acquisition transactions, often fail because of culture mismatch. And so understanding what your culture is and the culture of the companies who you've selected to target for acquisition, super important. So 6 things to think about.
Just one of my favorite lessons from Peter, which, in case you can't tell, I often cite Peter because he teaches a lot through Rockies Venture Club, and he literally wrote the book, Venture Capital for Dummies, is what is not an exit strategy. And so we have so many presenters that say, our exit strategy is to IPO or be acquired. Very general. In fact, we had one deck on the life science group that we reviewed the other day that just said IPO. That's our only exit strategy. And we were done at that point. So then people say, okay, I need to get more specific. I will be acquired by Amazon or Google. Okay, we hear that a lot too. And so they, okay, I know I need to get more specific. Relevant industry, say for my industry, life sciences. Okay, we'll be acquired by a Medtronic and they'll pick some life science tech companies. Again, that's not really an exit strategy. That's an exit outcome. Exit strategy, per Peter's point, is what are you doing now to prepare for that exit, to work towards that exit beyond building the company? What relationships are you building, et cetera, as he mentioned. So that's all I was going to add.
No, I think that's spot on. And I think some kind of practical ways you go about that. It's not necessarily a bad thing to be collaborating and partnering with potential competitors, right? We're in a networking space. That doesn't mean that we don't talk to Cisco. It doesn't mean that we don't talk to Juniper or Arista. We need to figure out where those companies are going, what their priorities are, how we may or may not align with them, whether it's a business partnership or a potential future transaction, as Peter was saying. And then the second piece on timing, it's important to also consider what your potential cap stack and valuation is as you move. And so, for example, if you come out of a Series B and you have let's say $100 million post-money valuation, just to pull numbers out, you have a certain return that you want to get for your investors. And all of a sudden there's a very small slice of strategic acquirers that can pay 5x cash on cash, so $500 million or whatever for that business. And so you need to think about your company's kind of life cycle as you move down the road, how that figures into your cap table and your valuation, and how you can orchestrate the right exit at the right time, at the right valuation, so that people get taken care of. Because what a good exit looks like changes quite a bit as you move down the funding lane.
Judd, that is such a good insight, and it points to one thing that I think a lot of founders struggle with, and that is, how do I create my valuation and my pro forma and my exit strategy and all these things? And when we get into due diligence, we start looking at these documents and strategies and asking questions, and it turns out sometimes these 4 things look like they are from different companies. So, we have a pro forma that shows a need for $1.5 million, and yet their ask is $3 million. That makes no sense. And then they're valuing the company at $5 million with no other raises, and they're saying their exit strategy would be at $10 million. Well, that makes no sense. So all of these things, valuation, pro forma, marketing strategy, capital, timing, all of those things need to be aligned. And it's really rare that all of them actually do fuse together appropriately. So, when you were describing that, I was like, that's sort of a meta due diligence thing. It's just, does this all tie together? Well,
and I think that's really hard as someone that used to be on the outsourced side of the equation, when you're a really early stage business, you often have outsourced finance, you have various marketing advisors, hopefully you have some mentors to the CEO, maybe you have some part-time executives in the business. You need to set aside the time and the budget to get a really synergistic plan together, right? You can't just tell your finance guy, go make this pro forma, this is how much we're going to ask for, and have it all work together. It's really a collaborative and iterative process, which I think as you move further down the line and you have a full-time executive team becomes, or should become a lot easier, frankly. But early on, it can be a real challenge.
So I'll just say, just a pitch for your former company that you were with, Richter Financial Studios. So they are unique in that they actually do all of those things, and so they can make them tie together. But with that comes a caveat, and this is a great way to look like an idiot if you're a CEO, and that is to say, I hired these great guys, and they have numbers, and I have them somewhere. and you see that over and over again. And creating the documents, even if they are believable, and even if they do weave together, is not success. And a CEO has certain things that they must have in their head at all times. And there's other things, you can go look up. But, thinking about where your pro forma is and what your exit strategy is and all of these things, those are guiding principles that need to be in your mental RAM, random access memory, ready to go at any minute. And so, if you get those sorts of questions in Q&A and you don't have them, that's a red flag.
Well, we do have to go to audience questions in a moment, but just before we do, I want to get a very quick sort of consensus from the group. I guess it doesn't have to be consensus, but what are some slides or piece of information or data or whatever that you see in pitch decks that you would tell people leave it out?
It depends on the company. So every company has a story, and we talked about the structure of a good pitch, but within that structure, different companies have different stories. But here's just a couple that are very optional slides, as far as I'm concerned. And one is the risks slide that just lists a bunch of risks. I like it because it shows awareness of risks and maybe mitigating strategies, so that's good. But if you're going to talk about risks in your pitch, better to talk about diffusing the risk that the investor is thinking about at the point in the pitch where it's appropriate. So if it's about competition, just say, hey, this may look like we're in a really competitive market, but we're creating a blue ocean because of X. So you don't have to raise a big risk flag. So that's one. Another one, was spoken about earlier, but that's the TAM, the total addressable market. Sometimes that's important. There's some industries where maybe I'm not exactly sure what the addressable market is or serviceable market is, and I can learn something from it. Others, it is very obvious, and you're wasting a slide to do that, or you're giving yourself a fumble to say that you're in the $68 trillion global market, which is a credibility loser. So those are some things that I see in there often that I would leave out. But the other one is not so much something I would leave out. It's actually something that must be in there. But a lot of times pitches start off with the first slide being the team slide. And this is a huge mistake. And the reason it's a mistake is we don't even know what you're pitching. We don't know what the company is, what you're setting out to do, and we see, a bunch of heads and some titles, and we have no idea if these are the right people to do it because we don't know what it is. So, it doesn't have to be your last slide, but maybe somewhere in those last 4 slides, once we know, problem, solution, market, finances, then we can see those people and say, oh my gosh, this is so exciting. Look at those people. They are the ones who are uniquely qualified to make this happen.
And what makes that team slide relevant that a lot of people forget, it's not the names and faces. A lot of say, here's our team. Here's their faces and names. What the investor is looking for is, why is this team specifically the people to get it done? What bona fides do they have? What knowledge do they have? And as Peter pointed out, you want to get to that later and not, like every other slide, not be too general. For example, I see oftentimes with a lot of team slides, they went to this college. That's not relevant to me. And that kind of goes to the central question of, well, what would I leave out? And I'd leave out anything that's not essential in telling your story. because the investor has a finite amount of attention. And while they're interested in their investment, they see so many potential deals, they can only give far less interest and attention than you, the founder, have in your baby and what you're working on. And so with that finite amount of attention, I often say the longer you make your presentation, oftentimes you're hurting yourself because you're taking that finite amount of attention and spreading it amongst more information. So if you make the presentation 3 times as long, I like to see usually 10 to 12 slides. So if it ends up being 30 slides, 3 times that, well, then all those slides are getting 1/3 of my attention. And some of your slides are really important, really relevant, and really the good stuff. And that's getting less attention now because there was so much that you were interested in sharing because you are so interested in your baby, what you're working on, that you actually end up hurting yourself by including more information. It's not even a break even. A lot of people think, well, I'll just include more. What could it hurt? Just in case. And so a way good presenters often deal with that, that there's more information they want to include, but they can't have it in the core presentation, is they create appendix slides. And that actually can make you seem really polished if someone asks you a relevant question and you can go right to that appendix slide, which has already forced you to come up with a cohesive answer to that question. That actually comes off really well when we're doing that meta due diligence process.
Yeah, I think to be brief, I would echo that, Murdoc. I think being really focused is important. An example would be, I see a lot of companies where you have a lot of different opportunities, a lot of different channels, markets that you could attack, essentially different go-to-market motions. And as an operator, that's really exciting because you have different ways to de-risk. Hey, if this thing ends up frankly not working, we can pivot over here. Don't bring that stuff up in a pit. You need to choose where are we having success, where are we doubling down, and tell that really clear, compelling story in that line. And then the second piece, I agree, it needs to be short, and you need to think of it in terms of multiple meetings. What am I sharing in my first meeting? What am I sharing in my second? And the goal is to continue getting those meetings with folks, and you have different information that you're trying to share, and you're always, of course, modifying that, right? Like a good example, we were fundraising a little bit ago, and we found out that we were planning to do a go-to-market and a business-oriented meeting. We found out that one of the folks joining, was a former CTO. Okay, well, you pivot really fast. Okay, we're gonna go tech deep dive on this one. But point being, if you're doing it well, you're gonna have multiple meetings to share that information.
So would you agree, all of you, that 10 to 12 slides is about where people want to be?
More or less, maybe 15, but definitely not 30 or anything over 20 is crazy because in a 5-minute pitch, you can do the math, right? I mean, 5-minute pitch, if you have 10 slides, that's 30 seconds a piece. And so if you've got 20 slides, that's 15 seconds, and it goes from there. So there's a certain point at which you just can't talk that fast.
And we do have one more question that I want to make sure we get to, which is, do VCs and angel investors expect exclusivity in their investment?
In our case, the answer is no. But there are some who want to own an investment, and the VC has a strategy where they need to have 20% of the equity in any one round or something like that. But for us, we are in the job of creating syndicates. And so, one thing a lot of founders don't realize is if you're raising $1 million and the average check writer in Colorado writes a $25K check, that's 40 cats you got to herd. And it's a really hard job. And if the average angel group writes a check for $350,000, that means you need probably 3 or 4 angel groups to be syndicating in on that as well. So especially in early stage, syndication is where it's at. But Series A, B, C, you'll see maybe it'll be 2, 3, 4 VCs who will be syndicating. But this is a way that investors use to mitigate risk. And in fact, they will even have what's called pay to play, where among those 3 or 4 VCs who are involved, they have an agreement with each other that if you don't keep your pro rata in the next round, bad things will happen to you.
Yeah, and I would just say I have not run into exclusivity, but at the later rounds, seed, A, B, usually that lead investor, the one that's going to do the due diligence, is going to want to, they're targeting a certain ownership percentage, 20, 30%, somewhere in that range. And from other kind of signals, you want your existing investors to participate in that future round, and you want to be able to tell the lead, hey, they would like to participate pro rata or take their pro rata, because that insinuates confidence within the existing investors.
Well, that's all the time that we have. Thank you so much, Peter, Judd, Murdoc. That's been just an amazing wealth of information that you've shared with us. Just so everyone knows, these will be available to watch on the Longmont Startup Week website. So feel free to check that out if you need to go through this. This is the end of our program for today. Thank you so much for everyone who attended. Thank you so much to our sponsors. Remember, tonight we do have the closing night trivia party at 300 Suns, starting at 4 p.m., going till 7. And if I could take the moment to just invite everybody who was involved in the production of Startup Week down. I'd love to give them a moment to give everybody a look at their faces. This was a huge event and well done. Thank you so much, everyone.
Hi, everyone. We want to thank you so much. That's a wrap for Longmont Startup Week 2021. We have a portion of the committee here, and so many individuals spent countless hours, over 1,500 hours, really building this program for all of you this year. So hats off to our committee members, some of them, and to the incredible moderators that we had this week, speakers, our production team, some of them are still meandering in, just an incredible group of people here comes sound, just an incredible, run, an incredible group of people that are really dedicated to seeing the entrepreneurial spirit not just live, but thrive in Longmont. Thank you all very, very much. We'll see you the 4th week of July 2022, and continue to follow us on all of our social media channels. You'll see a lot more content in between events now. Thank you again, and have a great weekend. We'll see you at the next event.